Hello traders, Cory Mitchell here with TradeThatSwing.com. We're going to go through a 4-step trading process to help you thrive in any environment. I should point out that thriving sometimes means surviving, so noting those market conditions and knowing when not to trade just as much as when to trade. And I really like this process because it's like step 1, step 2, step 3, step 4, and you have to go through them in order. And a lot of people get really kind of frantic when it comes time to take a trade, and they haven't done some of the stuff they should do, and now they're scrambling to do it, and then they open that trade and they're still trying to figure out, what should I do if this happens? What should I do if this happens? When if you follow this process, before you even click that buy or sell button, it's already worked out. You've accounted for everything. So the idea is to understand this process first. So we're going to go through the process, and then you would have to add the details and look at your trading plan and say, we need to add in these kind of rules based on this new 4-step plan. If I'm going to follow this, you're going to have to come up with some rules for yourself, some protocols, and so you would do that. But we're just going to go through it as if, whether you're day trading, swing trading, we are going to follow these 4 steps, and it's every single trade. So if we are midday day trading, we still go through this process on this trade. Even if we took a trade before, now this one, whole new process. This 4 steps for every single trade. And then on the next trade, we're going to go through the same 4 steps over and over and over again. I will point out that this seems like a lot, especially if you're day trading. You're like, how would you go through this in like 30 seconds before you place a trade? Well, it's partially practice, but it's also, I do something called commentating. While I'm trading, I'm thinking through all these steps ahead of time. So I'm seeing a pattern forming, and I'm already looking at making sure that, hey, I've let go. That's step 1. Then I'm looking at market conditions, and I'm looking at how am I going to plan out this trade? How do I want to trade it based on my own mental conditions, based on market conditions? And then once I hit that buy or sell button, there's nothing left to do. It's like it's all been planned out. So it's going to help to be watching your chart, planning things out, different scenarios as potential trade setups that you trade start to form. Because, even on a 1-minute chart, if you start to notice that pattern, a couple minutes early, you have a few minutes to go through all this. It's just going to help simplify the process. So the first one is actually our first and last step, because it's always, we want this between trades. So you maybe just had a trade, or maybe you're just starting the day. Either way, we have to let go and reset for the next trade that's coming up. Why? Because of the old phrase, to a hammer, everything is a nail. If you've been trading phenomenally lately, everything starts to look like an easy way to make money, and it is not. If you've had a string of losses, everything looks like a trap. It is not in reality. If you're angry, everything looks like an opportunity to get even. It's not. We're imposing our current mental state onto the market. We're putting our hopes, our fears onto the price action, and we're not seeing it objectively. So there may be good opportunities, but we don't see any. There may be no opportunities, but we see a ton, and we end up just whittling our count away, taking trades that don't go anywhere. This doesn't mean we can't trade if we're angry, maybe a little overconfident, anxious. These might be permanent states for some people, but we do need a process for handling these emotions. So we want to we don't need to be in like a totally perfect state to trade, but we do need to be in a state that's good enough to still follow this process. And that's basically the cutoff. It's like if you do not feel mentally good enough to follow through on the plan, then do not trade until you do. At least if you're trading a, normal sized account. If you're just starting out, then, if you're just risking a tiny fraction of your capital, then that may be okay if you're in a demo account. But once you're actually, trading a legitimate account for money that's important to you, then we don't want to be trading if we're not in a good mental state. So that's the first step. We let go of what's happened before. There's information in this article here on letting go. If you're having problems letting go, past trades really affecting you, you can check out that article. So I'll post the link to this 4 steps below the video on YouTube, so you can come check out and read some of these other links which are important. So if we feel good enough to implement our plan, then and only then do we move to step 2. And that is assessing market conditions. This is more elaborate than most people think. Most people think I read a lot of trading plans where it's like, okay, I'll take a trade if the price is above the 200 simple moving average. Okay, well, that's a mediocre starting point, but what really matters is how the price action is moving relative to what you would usually do. What the market's doing, just, if you just look at it and you can make all sorts of comments about it, but until you actually compare that price action to what you typically do, it doesn't matter. Because maybe price is running beautifully, but you never seem to capture those types of movements because you're just going for quick little profits. Then it doesn't matter. Is the environment good for your strategy? If you're capturing quick little profits, is the environment good for that? If you're trying to capture big runners, is the price action good for that? Is the price action choppy? Is it moving quickly away from your potential triggers? Now, you might just be starting the day. You might just be looking at the last few candles. Maybe you're swing trading. A trend has been going on. You haven't been in that trend, but you can still look at the movement and infer that, if patterns were developing, if trade triggers were signaling, how is that stock moving for those types of patterns? Is it whipsawing around entry points, which is a potential problem? So you can, even if the pattern you trade wasn't there, so like I have a specific kind of trade trigger. It's like the price has to move above a candle high or a candle low. So I can look at prior candles. I don't even have to see the pattern. How is price acting when it moves above and below prior candles? Is it having quick movements? Is it whipsawing around? Is it getting stuck? That's information I want to know, because that's going to directly impact what I'm doing, right? And that's what's important, because what I'm doing is what's going to make me or lose me money. So it's not just about market conditions. It's market conditions relative to what I usually do. Is the price coming up to major resistance or support levels? How do you typically trade around those levels? What do you typically do? How's that going to affect your trades? Is the price moving enough to reasonably hit profit targets? What kind of profit targets? Maybe today it's only going to move like, usually you're trying to go for 2 or 3 reward to risk, but the movements are really small. It's like popping and then it's pulling right back. It's popping and it's pulling right back. So if you want to catch one of those pops, maybe you have to go for a 1.5 hour trade. That's going to come in planning, or you might not want to trade at all. So all this is market conditions, And so I'm thinking about how it's going to affect my trades. I'm looking at conditions, even if a trade setup's not setting up, because that's going to affect if I can already see, there might not even be a trade setup forming right now, but if I can see that market conditions are not good, even if a trade setup did form, then it doesn't matter. I know I'm not trading. But if I can see, price is moving really well for how I trade, then I know if I see a setup, I want to be taking it. So remember, this, like I said, a lot of people get kind of messed up trying to incorporate too much all when it comes right time to take that trade, or they're impulsive because they haven't been looking through the price action and they just see a trigger and they jump in, and then all of a sudden the thoughts come flooding like, oh man, like maybe this wasn't a good trade. Is it a good trade? I don't know. The market conditions aren't very good. Before you hit the buy or sell button, this should be done. Market conditions. We know, yes, we're going to trade, or no, we're not. If it's good enough to trade, then we move on to trade planning. So it's like we're constantly assessing. Our mind frame's good, so we move on to market environment. Market environment, we're constantly just analyzing. So that's what I'm doing all day. I'm just looking at all the time I'm trading. I'm looking at the price action. I'm looking, okay, is it a little choppy? Are there any support and resistance nearby? How much is it moving? Then if I'm kind of like giving myself a check mark if market conditions are good. And that means I can look for trades. If market conditions are not good, I like have a big X in my head. I like will visualize it like a big X. And that means all I'm doing is analyzing market conditions. There is zero possibility I can take a trade. My hands are off the keyboard or the mouse. There is zero possibility I can take a trade. Big X. Until those market conditions change to a check mark, at that point I can start looking for trade patterns and signals. Once we have a good environment, a good mind frame, good environment, then we move on to, we can start planning out trades as they form. So this can be fairly simple, or it can become more complex. If you have just used the same kind of exit rules every single time, then it's just you take your entry and you follow your exit rule. That's it. We could also do something we call scenario planning. This is what I do, so it's kind of a step up. It's going to become more complicated, but I prefer it because my personal belief is that every moment in the stock market is like a snowflake. It all kind of looks the same, but you never have two moments that are exactly the same. So every pattern, even though I'm always trading the same patterns, rounded tops, rounded bottoms, double pumps, range breakouts with confirmation and false breakouts, like it's the same thing over and over and over again, but every single situation is just a little bit different. You had a different size of move coming in, you have a different size pullback, you have a different size stop loss, you have a different size potentially target based on that stop loss. And so I prefer to assess each trade on its own, as well as having kind of an overall trading plan for how I handle these situations. So we have the all-encompassing kind of rounded top, what it looks like, how I trade it. But then on each individual trade, I am fine-tuning that a little bit. And an example might be, we have huge movement in the market, like just in the stock or Euro USD, whatever I'm trading, like huge movement, and then I get a rounded top. If I see that huge movement and that's kind of what I'm expecting coming out of the pattern, because that's what has been happening, maybe I'll throw like a bigger reward to risk on there to capture some of that bigger movement. So, my kind of average is about 2-to-1 reward to risk. But if I'm seeing really big movement, maybe I put a 3 or 4R target. So I'm going a 4-to-1 reward to risk because the market's offering that kind of movement. Whereas if maybe the market's a little quieter, it had like a smaller move up, then it forms the rounded top. And in that case, maybe I only go for like 1.5R because I can't really expect a huge move because no huge moves have been occurring. It's a slower moving day. So I can calibrate each trade. So I'm planning out how I'm going to make this one. And it's still kind of within the overall guidelines of how I trade the pattern, but I do view each one as a snowflake, its own little unique entity. So I'm going to trade it as such, and I'm going to give it some respect and some thought. And I've already assessed market conditions, so that can help me plan out how I want to do this trade. Like, yeah, there's a lot of potential for the price to run. I'm going to, maybe use a bigger target and maybe a trailing stop loss to try to make even more if it keeps running. So yeah, I'll plan it out that way. And I can also plan for my mental state. So we had talked about how you might not be ideal mental state all the time. That's okay, as long as you have a process for planning and for managing. So I actually find I can trade quite well when I'm angry because I direct it into like just waiting for fantastic moments to enter, and if it doesn't work, I like cut my exits like immediately. It's like I'm almost trading with zero risk, and I can do that very well when I'm angry, and I can like chip away at a loss because I set a daily loss limit for myself. So if I get close to that, I kind of have to like chip away to give myself a bit of room. So this kind of comes into that planning. It's like I can't really trade normal. I can't give myself a full stop loss. I only have like a tiny bit amount of money to work with here. And so I need to like chip away. And so it might be, I see a nice pattern I like, and it's like it has to go immediately. If it doesn't, I'm just going to get out. And I'm basically looking for those trades that immediately move in my favor. And so I can trade good that way. But I found a way to plan for it. And basically when I'm angry, that's how I trade. Because I'm only usually angry in that specific circumstance when it's like really, usually I haven't been trading well. If I'm anxious, I'll use a trailing stop loss. I find that easier for me to implement. I know my mind's not quite right. If I get a deeper pullback, I'm probably going to panic out of the position. So I'm better off just using an aggressive trailing stop loss. And then that way, if it pulls back at all, I start to get out. So I end up with a better exit than I would have if I just tried to trade normally in an anxious state, because I know in that anxious state, I'm going to get the worst possible exit. Whereas with the aggressive trailing stop loss, I'm going to get a better exit than my worst exit, if that makes sense. So I will plan for market environment and mental conditions, because your mental state is just as important as the market, because as we talked about, it can impose its own will. It can make you see what it wants to see. And so we need to accommodate for that. I do not agree with trying to stifle the emotion, as opposed to, I think we accept it fully and then plan for it. And by doing that, we're going to handle those emotions better, because they're going to come anyway. Anyone who tells you you're not going to get emotional while trading is an idiot, because you will, if you have a normal functioning brain. If you do not, then, you're lucky in a way. But you're going to feel emotions while trading, and stifling them is not a good approach at all, I don't think. I would much rather accept them and plan for them. And then that way you can trade through a wider range of emotional states, right? You have more freedom to trade. The less you accept your emotion and the more you let them sabotage you, the narrower and narrower the environments you will be able to trade in. Because if you constantly get angry and you know that you can't trade when you're angry, then now that's one mental state that you can no longer trade in. But if you can learn to trade through all your emotional states by planning them out and still being able to execute pretty well and do well through those emotional states, now you can be trading most of the time, most of the opportunities. So I think it's just way better to like say, hey, yeah, I'm angry. This is what I'm going to do on this trade to manage it. If we do that, we're going to be miles ahead. Trade management, if you've thought through all this stuff, then trade management's a breeze. You're just basically following what you did in stage 3. You laid it all out. You've already analyzed market conditions. You've already assessed how you want to trade on this little snowflake that you're about to trade. You've given it thought. You have your overall rules from your trading plan. Maybe you fine-tune them a little bit for this specific trade, and you're ready to go. And now it's just a matter of implementation. If you're thinking a ton and you start thinking about market environment and those types of things, you probably didn't do a good enough job earlier on. So you were kind of just going through the motions, looking at your chart, saying, yeah, it's fine. And then you get into the trade, and all of a sudden it becomes real, and you're like, oh man, like, is the environment good? I don't know. That shouldn't happen. If it does, that means probably something earlier in the cycle is not good. So we've committed. When we place that button, we're saying, I have gone through this process, and now I'm hitting the button, and I've committed to what I've thought through. And most people are just hitting buttons with no sort of commitment or forethought. And so if you can get this cycle down, wow, you're like way ahead of most other traders. And it's going to take some work. Like I said, it's this seems like a lot, but of course I'm explaining every detail. But you can go through this whole process in, a very short amount of time, especially if you are just doing it all the time. So like I said, I am just constantly checking in, market's moving second by second, even with day trading. Like there's loads of time to do this, even if you only have a minute between trades, because most of it should be done already, right? You're constantly assessing, hey, how am I feeling? Okay, I'm feeling good. Let's go. Market conditions, yeah, we're still moving good. No support and resistance in sight, that kind of thing. And then a trade starts setting up. You have a lot of time usually before a trade sets up, whether you're using an indicator, price action. It's like, so for a TC, that's one of my most common patterns. You just have a strong move up, let's say it's up or down. Strong move up, I'm looking for a pullback, and then once it starts moving up. But I'm already planning that trade out. As soon as there's a sharp move up, there's going to be a pullback eventually. I'm thinking, okay, where do I want that pullback to occur? If it drops way too far down, then that kind of eliminates the upward bias. I don't want to trade that. If it just stalls right at the top, I find those sketchy. So ideally, it ran up here. I kind of want it to pull back into this price range. And then I want it to form a relatively small stop loss. I can measure out the movement of that big up wave, kind of gives me a sense of how far the next one might run. I'm going to be conservative. So if the last one ran up $1 and then we get the pullback, maybe that next one's going to run up maybe 60 cents to be conservative. So then I need a stop loss that's less than that. I'm figuring all this out before the price even forms the full pattern and gives me a trade signal. So that by the time that trade signal occurs, I know exactly this is a good trade. I can commit to this. I know how I'm going to plan it, or this is how I've planned it out. I'm going to stick to this. I like it. The market environment's good. I feel good about it. Boom, if that trigger comes. And sometimes it's all wasted effort, right? You go through that plan, and then the price just keeps plummeting. You're like, okay, well, there's no setup there anymore. Now you start looking for the next one. How is the environment? Is it still good? Do I still feel good mentally? We just had a big drop because, I was waiting to go long, but instead it just dropped. Now, maybe if we get a pullback, I start looking at the short. How does that look? Do I feel good about the environment? Does it fit my strategy? So it's just constant. And if we do that, then when those trade triggers come, we're like, we feel mentally good because we have planned the shit out of that thing. And all we have to do now is follow through on it. So I hope that helps you. That's the quick summary list. Your letting go is your first and last step always. Every new trade, it's the same thing. So we're just going from next trade to trade to trade, and this process is always in the middle. So yeah, I really like it. I hope it helps you out, moves you from step to step so that, yeah, you don't get that kind of frantic feeling once you enter a trade of, oh man, I didn't think of this, what if this happens? It's already done for you. So if you want to read through this, and there is a little bit more detail provided at the bottom here, you can check out. I'll post the link below the video. And yeah, if you like this kind of content, I know this is like a little more in depth than, everyone wants simple trading information. And yeah, to be honest, I don't think that's going to get you very far. I think you need to dig into deeper processes like this. So if you appreciate this kind of content, share it, like it, subscribe to the channel, and we'll see you in the next video.